right? I'm not exactly gonna say welcome to second semester, right? Because maybe you could be listening to this and it's first semester, whatever the case, but we are dealing with analysis of financial information. So like I promised, I think in the groups I indicated that we are gonna deal with the question, right? So we are gonna try and tie up this information to the question that we are gonna be dealing with. So when it comes to ratio and analysis of financial information is basically ratios. And if you have seen past exam papers, they carry huge marks. So this is just an indication of how important this topic is, right? So this is why our examiners decided that in almost every examination, you're gonna get it. And not only are you gonna get it, but it's gonna carry quite a huge weight there. So the question that I sent in the groups, I think it's this is the question that I sent in the group. So it was an FI concession. It was in April this year. We are in 2023, right? So we are just gonna work out the ratios part and then discuss basically your strategy, right? Your strategy in answering these questions, right? Your strategy in answering these questions, because it's highly likely that you will get these questions. And the smart thing to do is to familiarize yourself with these questions. All right, but okay, let me just skip and go to the questions here. So we are given, if you've had time, okay, I hardly ever have time, even in an exam, to go through all the statement of comprehensive income in detail to have a look and see. I just quickly go straight to the required part. I want to see what's required so that we can tailor our efforts and our energies towards what's required, what's going to give us marks. So that's also going to be your strategy, by the way, right? So in every examination, you first go straight to the required and then you see what is expected of you before you waste time reading unnecessary things that you are not, some of these questions might be so difficult that you are not even going to answer it. So if you are not going to answer it, don't waste time, right? Just focus on the ones that you are going to deal with. So question A, the one that we are dealing with, calculate the ratios, which is 1 to 6 for 2023. So we are dealing with 2023. So you need to be careful whenever you are dealing with financial statements. Look at the dates, watch out for the dates. I think those of you that are doing FACs will rally behind me on this one. You need to be very careful when it comes to the dates. And then we are supposed to show how many of our workings, all of our workings, and round off the final answer to the nearest 2 decimal places. So this is important, by the way. So we also have to check to how many decimal places we need to round off our answers. So this is a good 13 marks. And then part B is compare the ratios for 2023 as calculated here in A to the prior year. So I suppose the prior year is going to be given in, which is 2022, right? And then we are supposed to provide reasons for an improvement or a deterioration. Take both the information included in the financial statements and the additional information into account when providing your reasons. All right, so this is where third level comes in, where you need to reason out your solution, right? It's not just about the punching of figures. So punching of figures is very important, and we assume that we can all use a calculator here. So they are not going to be so much interested in that. I think you must get about a mark for your calculation. But here's the thing now, you can't really progress into B without getting A correct. And the total of this is a good 25 marks. So we are supposed to use this format here. So what are we supposed to calculate? We have been given now. Current ratio, asset test ratio, debt to equity ratio, gross profit percentage, and then the return on total assets, as well as the inventory turnover, right? But before we jump into those calculations now, let's look at just a little bit of theory on this ratio analysis, right? Why do we do ratios in any case? Why do we do ratios? Why is this so important? So when we are dealing with ratios, like we already indicated, it falls under the analysis of financial information. And by the way, if there's anything that you don't understand, feel free to stop me anytime, right? We are on Zoom, so nobody's gonna see your face. Don't worry about asking, there's no question that is, what's the word? There's never a bad question, right? And the most important thing is a question, because it helps me and you tailor the class towards what is profitable, right? So this falls under the analysis of financial information, where I already indicated that we've got ratios as a financial ratios as a type of, sorry, as a topic within this broad topic. So if you look at financial statements, for instance, we were flipping through here, we went through financial statements, right? Except that we've got these financial statements, they say they are abridged, right? When we have 2023 and 2022, there is little information here to assist us in terms of, because we are dealing with analysis of financial information. So as a user of these financial statements, remember, these are drafted for different kinds of users. So as a user of these financial statements, they must at the end of the day make sense, right? And in this instance, you are a financial manager, right? And there are many reasons why you need to make these statements make sense from the perspective of a financial manager, right? Both in terms of when you're looking at this from the organization that you are part of as an internal user of these statements. But in some other instances, you might have to be analyzing financial statements of other organizations for one or more reasons, right? So if you are just looking at these as figures, right? These as figures that have been abridged together, the only thing that you could possibly see here is that in 2022, it was 1,800,000, or it's 1 billion, it was 1,800,000, and it went down to 1,500,000. But other than that, it does not make any sense. It's just numbers, right? These are just numbers. So for these numbers to make sense, they need to be compared with each other, right? They need to be juxtaposed with each other for us to see the relevance of these numbers. So which is where we talk about financial analysis. So we are basically analyzing financial information which is found in those annual financial statements. We are making it make sense. So we want those to communicate with us. So how do we do that now? Then it's through ratio analysis, right? And we'll get to that again in a moment. But what are the main objectives? So these notes I think I provided last semester. I'm gonna throw them again in the group for those that joined now. So if you were here, I think from the beginning, particularly if you are doing MAC 371, you should have these notes because we are redoing finance, right? But if you are new, in any case, I'm gonna put this up there after the class for you to go through. Right, the three main objectives for financial analysis: you basically want to evaluate an organization's prospects for the future, right? Maybe to help fund providers with investment decisions. Maybe you are an investor, you are doing this analysis for your company, which is trying to invest in another company, which is what we are gonna do, right, much later. Maybe this is what you wanna do. You must, at the end of the day, be able to analyze information. Someone can't just throw figures at you and tell you that they made a profit of 1 billion, and then you just get excited over that. You need to be able to analyze that information, right? And then, of course, to evaluate the performance of the organization's management as reflected, right, in an analysis of their historical financial information, right? So you wanna see how well are these guys doing. Maybe you, as an investor, again, you've put in funds, you've pumped in a lot of funds in an organization, so you can't just sit back and assume and wish that things are being done well there, right? History has taught us that things don't always go our way, right? But then you need to, this is gonna help you make decisions, right? Remember, the whole reason why we are preparing financial statements is to assist in decision making, to assist these users in decision making. So in other words, they might wanna decide to buy or sell a share. But again, you can't just decide over a dream, right? And you can't even decide that over an assumption. You need to do some calculations, right? Make an informed decision. So you go through the financial statements, make an analysis, and then decide, where is this company going, right? Sometimes you have so much power within that organization as a majority shareholder, you can fire management, right? You're probably someone like Elon Musk, you just bought, what did he buy? Twitter, right? And then the first thing that you want to do after you buy Twitter is to fire that management. Maybe you're not happy with how they've been performing, right? But at the end of the day, before they take you to what you call this court, CCMA, then you need to have evidence that they haven't been performing well. Some of that evidence could come from these financial statements there. Then, of course, like we already mentioned, for internal decision making, right? This is when you are within that organization and how good did our profit do, right? We're looking at this in 2023, looking at it against maybe 2022. How good have we been doing, right? What sort of changes can we implement in this particular year or in this new year? So this will basically help you in your decision making. So you must understand. So as a management accountant, as a financial manager, you need to work hand in hand with your accountants, right? But more importantly, you need to understand accounting, right? Which is why I'm sure most of you did FACs and some of you are still doing FACs, because you need to understand these financial statements before you can assess them. Maybe be in a position to draft one, right? But for the sake of this module, you're not exactly going to be asked to draft those statements, right? So who are the users of these financial statements? So these are covered second level, right? You've got all this information from MAC 2602. The capital providers and the financial analysts. So capital providers could be you, I presume you're Elon Musk, right? And you want to buy shares within a company. So you are providing capital there. And again, you could be a bank, right? You could be a bank. And then they've approached you and said they want a loan. Now you're working for this big bank, you're working for Absa, right? In that big office, and they come to you, you know, looking all smart. You know how these corporate people look, they're looking all smart and they want a loan from you. So because you know not to judge books by appearances, right? You request for a copy of their financials. And then what you do, you analyze that before you can grant them those loans. Okay. And then, of course, as a financial analyst, so some of these financial analysts, maybe you are, these rich people are coming to you for advice, So you're sitting there in your office, so you must be able to give them, some worthwhile information. Then suggest to them, recommend whether they should buy, sell, or. Remember, if you have a question, anytime. If I'm moving too fast, right, you can just stop me anytime. And then creditors, who are these creditors? So creditors, they are providing on credit, right? Name gives us them. We are not required to pay in advance for those. So they will also need, before they can extend that credit facility to you, they will need to know how well your business is doing. Otherwise, it doesn't make sense to, to provide someone a huge credit and then at the end of the day, they are unable to pay that, right? So you need to be able to see and to assess that organization. What are you assessing in particular? Their ability to meet their short-term obligations, because as a creditor, you are part of current liabilities, right? So these guys are owing you, but they must pay within 12 months. So how do you know that they are going to pay within 12 months? The best indicator, if you're not going to be taking their word for it, right? You can't just, if you're in business, you can't just take anyone's word for it, right? The best thing to do is to request again for the financials and then assess and see, right? Analyze their asset structure, right? The short-term asset structure and the short-term liability structure, which is your current assets and your current liabilities, and see, in all likelihood, in which direction is this going to go? Are they going to be able to pay? How many other people are they owing that they need to pay within such a short space of time? You see. So if they are going to be owing the whole universe, then you can't obviously put yourself in that list. you are putting your organization in danger, right? The management, of course, in this instance, you are most likely doing this module in the pretext of being a financial manager, right? So it's gonna help you again. Maybe you are in the management team, right? Here we assume that you are a financial manager, right? So as a financial manager, how can that assist you? So this can show successes, it can show what successes, strengths, and okay, sorry, I think I got the other machine here got kicked out. I'm gonna put it in just now. Sorry about that. You see this network thing. While it's loading, do we have any questions?
No, not on my side.
Oh, perfect. All right, we are back here on this other gadget. And then other users, now we are talking of employees, auditors, SARS, and the likes. Do you know how hectic it is when you get audited by SARS? Well, I've never had a direct experience on this, but the other guy that I used to work with, they were once under an audit with SARS. It really gets hectic because I think you need to keep your financials for, I believe it's 5 years, right? So SARS is basically gonna bring, right, let me see if this is still on. Okay, I think it's still. Okay, it says the screen share is still loading here. So let me stop the share and redo this thing. It only says I've started sharing, but I don't see it here on the other screen. All right, there you go. So when you are being audited by SARS, they'll sort of like maybe bring a team of 5 guys. They'll be doing crisscross checks on your financials. One is checking from the left to the right, the other is checking from the right to the left, the other one is checking from the bottom to the top, bringing all sorts of questions, and you need to have answers. It's very hectic there. All right. Let's continue. Hey, sorry guys, I keep getting kicked out now. Let me see what's connected there. The one gadget is doing very well and the other is not doing so well. All of a sudden, I don't know why, but we will proceed. So I think on the other sheets that I'm gonna send after the class, there's basically gonna be a list of the ratios that we're expected to use in this module within the bounds of good taste. Not quite a huge list. It's not really a huge list, but I'm also gonna provide that to you. Let me just flip to that page now. Maybe this other page is tired. So this you are gonna get, by the way. So it will basically give you, like you can see here, our ratios can be, I don't know if you can, okay, it's gonna appear on your screen now. Basically be broken down into 4 different categories, right? Which is the profitability and performance, then liquidity, then the capital structure, and then the financial markets. So that's what those ratios are about. All right. Right, this is still loading, by the way. Let me just reconnect this. Just give me a second. Let me pause the recording so whoever is gonna be listening to this doesn't have to waste time while the network is loading. Those are the 4 categories that you get. So at the end of the day, what I would advise, just do one question like the one that we are dealing with. Yes, some of the questions are on the question bank, but we'll keep redoing these as we go on with the module so that you familiarize yourself with these calculations. But I'm gonna deal with some of the tricky things tonight after we are done with our calculations as per that question paper, right? So these are the formulas. So on these formulas, we are simply applying those formulas, right? Simply applying those formulas. So here, it basically gives us a brief all right. Sorry about that brief pause. So it basically gives us what you get here is just a slight, in some instances, a slight description of what's happening here, right? In terms of the ratio, right? Just a brief, something that is brief, just to keep you in check with regard to a particular ratio. So you are going to get this again. Right, let's jump to our question now. So these are the ratios that we intend to calculate today. Okay, let's take it from the answer sheets there. Right, so I'm gonna do these ones on Microsoft Excel there. So I'm just gonna copy and paste them. So let me just start off there with the current ratio. Right, so I'm just gonna put right. I'm gonna take us to the spreadsheet after I'm done with copying this. After I'm done with copying these ratios, the acid test, right? I'm just copying them. Right. Then we're gonna work them from. So if you've got the question paper open there, it's gonna be a good time for you to keep your question paper open on the side. All right. To keep your question paper open on the side, so that whatever we do, you can be able to trace the figures and to see where those figures are coming from, right? That's actually very important, so that you are not blind, right? Maybe as a financial manager, the accountant in your team, or you could ask a junior in your team to do the calculations for you. But at the end of the day, you need to understand the calculations. So you might not exactly be doing these calculations in practice, right? But someone is gonna come to you with a list of with the list of ratios and a list of formulas. Then they start talking Greek to you. You see, which is not good, right? So you need to be able to understand what's going on there. All right, so this is what I've done on the site. Let me just fill you in here. So this is what I've done on the site. So I've just put those ratios there. Right, there you go. I've just put in those ratios there. The current ratio, the acid test ratio, the debt to equity ratio, gross profit percentage, then the return on total assets, and the instant turnover. So we are just going to discuss these. So with ratios, first and foremost, you need to understand what this ratio tells you, right? What this ratio is trying to communicate to you, right? So one trick in passing this module, not just in passing this module, but in passing any module that you are ever going to, is once you are dealing with financial management, for instance, forget every other module, right? Put on what I would say is your financial management thinking cap. So in your head now, tell yourself that you are a financial manager. So you have to think, you program yourself to think like a financial manager. Right? So the reason why most students and most tutors, most individuals don't get this right is because myself, for example, I also tutor economics. I also tutor costing, by the way, which most of you are doing. But when it comes to financial management, I forget all the costing, right? I don't think like a manufacturing manager. I come here as a financial manager, right? So once you program yourself, you tell your mind that, okay, this is the time for financial management. So for financial management, then which means every decision and your thought process is basically wired towards financial management. So you're able to, even without opening a textbook, think like a financial manager. So this becomes logical to you as a financial manager, right? So for instance, let's start off with current ratio. So the current ratio, this I think I did in high school, right? So in high school, we had to cram these. Second level, we also had to cram this. It's a good thing if you can remember it. If you can't remember it, this is an online exam. You can always flip through. We've got your formula sheet there. So you can always flip through your formula sheet there. You will get your answer to this. But your starting point is having the formula, right? So this is your current assets divided by your current liabilities, right? Divided by your current liabilities, right? So this is just as basic as it is, right? On the surface, this is what you get there on that formula. So once you flip through, say, to your formula sheet, and then you've seen that, okay, it's your current assets minus your current liabilities. The next step now is when identify that from your statement of financial position, which is also called your balance sheet, right? So you wanna go and look that up there and see if you are getting that. So I think they said we need to do this. We need to round off to 2 decimal places. So let me do that there quickly, right? So step number 1 is getting the calculation, getting the formula right. Then by so doing, you will get the calculation right for the most part, right? Because these ratios are not so complicated. So let's go to information where we can get our current ratio. So where can we get our current ratio? We already said in our statement of financial position, where we can start off with our assets here, right? So current liabilities, what kind of current liabilities we are looking for? The total. So the current assets, my bad. You're looking for your current assets, what kind? Your total. Right? So where do you get that total? This is the total here. So the way these are structured here, on top there is the total of what's inside, right? That's what that means. So in other words, if you're looking for your total non-current assets, it therefore follows that your total non-current assets is gonna be your long-term financial assets plus your PPE there. So if you add up these two inside the box, it's gonna give you the total, which is on top. So this is how these financials are structured. So our total current assets, therefore, is gonna be that 1470 there. So let's rush there and put that 1470. So I'm not exactly gonna show you working for that, but we'll put it there as 1470. 1, 2, 3. Or for the sake of clarity, let's just put it there, right? Because sometimes we need to see what's being excluded and what's being included, right? So I'm just typing that on the Excel sheet. I'm gonna take you there just now, right? So we've taken that 1470 there. So we're gonna divide it by the total of current liabilities there, right? Total of current liabilities. So what we have there, the total is 613. And that's what we have. So that's the amount that we need to pay. All right, so 613, 1, 2, 3. That's what we have there. So let me just take us to what I'm typing there. So that's basically what we have, right? That's basically what we have there. So part of your job in your examinations, right? Part of your job in these examinations is to ensure that your staff is to ensure that there is clarity, right? Is to ensure that there is clarity in the way in which you are answering these questions. So with that one there, we have already been given the format to use, right? We will stick to that format under normal circumstances. But now I'm doing this one here so that we can incorporate the workings, right? So that the marker can see that you didn't go to some prophet and they gave you an answer straight up. They need to see where you are fetching those answers, right? You're not just sucking them off your thumb. You're actually doing calculations for that. And it might save your skin, by the way, if for some reason you are getting something wrong. Ne? So it might save your skin showing those workings. You might convince the marker that this one knows what they are doing, you see. So you basically want to grab every mark that you can get here. All right, so that's the calculation there that we have, right? That's the calculation there that we have. So let's do it over here on this column. So it's gonna be 1470 123 divided by 613 123. 2.40. Very easy, right? What is the acid test now? Right. So we're gonna start off by building from current ratio, right? And then juxtaposing it with the acid test ratio. Why do we have an acid test ratio? Because these basically measure the same thing, right? But we'll see why the other one is called the acid test. So if you check on your formula sheet, this is gonna be your current assets, but less your inventory, right? Less your inventory, and then you are dividing by the same thing, your current liabilities. So on the notes there, right, on the notes there, you just want to check again what these classes of ratios tell, right? I'm just going to go to that again shortly after this so we can see what's going on with that. Right? So allow me to just put this down. We just fetch the information here and then we'll discuss this. So as per the formula, we are taking this total, right, which is 1470, which is the total that we had. So I'm just going to write down that there, 1470. But we need to subtract from that. We need to subtract our inventory. So every time we talk of these lecturers have been talking quite a lot about principle, right? When they talk about principle marks, then they are basically saying you need to demonstrate that you understand the principle of what's being discussed in particular, of what's being done there in particular. So the principle in this instance is when they are asking you about the acid test, of which is sometimes called the liquid ratio, they want to see what you are going to do with inventory, right? They basically want to see what you are going to do with inventory there, right? So whether or not you understand that principle there. So we are just going to do the calculation and then we go on to that formula sheet and then we talk about what's here. So minus 400,000, 1, 2, and then we are dividing that by 613, right? So it basically gives that, which is slightly lower than that there, obviously for the reason that we had to deduct that inventory there. But let's go back to these here. So these ones in particular now fall under the liquidity ratios. Right? They are falling under the liquidity ratios. And then if you check on your notes, I believe it's there on the notes. When we talk of liquidity ratios, we are looking at liquidity basically deals with when we say something is liquid, you are dealing with cash, right? You are dealing with cash. So obviously, if you are going to be talking about cash, then it's something that is going to be in the long term. Right? So if you are going to rate your assets from the least liquid to the most liquid, then you will discover that cash is obviously going to be the most liquid, right? So you are basically dealing with your working capital here, right? So what is working capital? Working capital is this portion here. Let me show you what working capital is. So your working capital is basically your current assets and your current liabilities. So because we are saying we want to give this meaning now, then we are giving this meaning in the form of comparing these numbers against each other. Hence, we have now our current assets divided by our current liabilities for the starting ratio there, which is the current ratio. right? And then they are saying it's a primary measure of an organization's liquidity, obviously, right? So whenever you are asked to comment or assess an organization's liquidity, then your starting point is the current ratio. So what does it measure? If you check again on the notes, they should tell you that it basically measures how well your company is managing its working capital. So what does that mean? We already discussed earlier when we started the class that, let's say you are a creditor and you want to extend credit. You are looking at a company that is going to be able to pay you back that money within the next 12 months, right? So which is going to be, in accounting, when we say current, we are looking at that 12-month period, right? Anything that is 12 months and less is current. So you are saying, ideally, you are going to be a creditor, right? In their balance sheet or in their statement of financial position. Then you are saying if you are gonna be successful as a creditor, then they have to afford to be as a creditor. How do you assess them, or how do you assess their affordability? Then you look at their current assets, right, against the current liabilities, because the norm is you need to pay off your current liabilities using your current assets, right? Let me just go back to the statement of financial position again. So any of these, all these here belong to the organization. They are still part of your assets. Whether they are non-current assets or current assets, they are still part of your organization. So at the end of the day, we expect that your liabilities have to be financed by your assets, right? Otherwise, there is trouble in an organization. If, for instance, you have got your liabilities exceeding your assets, it's bad news, right? That's bad news. But we start off our analysis now on the current assets and versus the current liabilities. So we are saying your current liabilities, which are down there, your current liabilities need to be financed by your current assets. So you don't want a situation where the organization is selling non-current assets to pay for these short-term creditors. It's a very bad indication, right? It's going to be a very bad indication. So you do that kind of assessment there. And then they did say, as a guideline, you expect that it has to be within a ratio of 2:1, right? But again, this is relative, right? It's very much dependent on the industry, and because we are doing this analysis here, you want to compare this with what happened last period, like to see if there was an improvement. So if it's too high, say if it goes to 3:1, it's just an indication now that you've stuck up a lot of investments in these current assets, more than necessary, right? More than necessary. Remember, current assets are just good enough to the extent that you are gonna resell. You're just gonna sell this one. For instance, inventory, you just wanna sell that inventory. So if your current assets are way bigger than your current liabilities, what's the reason? For instance, if your inventory, it could be that your inventory is too big. So if your inventory is too big, that's also not a good indication, because it incurs a lot of costs, right? In terms of storage. Some of this inventory might be, it might be damaged because you've got it in the warehouse there. What if it catches a fire? You see, think about insurance. Think about the risk of theft. You see, so you also don't want to keep too much inventory. But again, like I said, it depends with industry and the particular circumstances that you are dealing with, right? Sometimes you know that maybe there's gonna be a lockdown. Like now in Cape Town, if you've seen on the news, they are currently on lockdown, right? Those are currently on lockdown. Okay, sorry, I just got kicked out on that other nation. But if you look at Cape Town, for instance, they're on lockdown now. So depending on how long that lockdown is going to be, it might be necessary for you to stock a lot. So there are no hard and fast rules on this, right? Because you are a third level student, we want your mind to be able to play around with different circumstances that could come up, right? Circumstances where it could be good to have a lot of inventory, to have a lot of current assets, and then instances where, so under normal circumstances, you don't want that to be too big, right? You just want to keep it simple there, right? So if it's a situation where you are asked to comment about why your current ratio is big, then it's big because one or more of these is too big, right? Which can be a disadvantage, like I'm saying. Trade receivables, if you have a lot of debtors, you risk them going bad, right? And then other current assets, maybe you are looking at prepayments, etc. You could have them under that category there, right? I don't know if this is showing. All right. Okay, yeah, we've got the screen there. Your cash balance is, again, if you are around South Africa, you know it's not a good idea to carry around a lot of cash. It's not really a good idea to have that in your business. Again, it's not a good idea, right? You are going to be in trouble with the robbers. Some of your employees are going to give these robbers a tip off, then they are going to come, of course, and mark you guys, and then insurance is going to give you problems. Why are you keeping so much cash anyway? You see. But again, this is within the bounds of good reason, right? This is within the bounds of good reason. So in your analysis now, you want to first of all understand what this ratio tells you, right? So this ratio is basically juxtaposing your current assets versus your current liabilities, basically assessing how well your working capital is being managed, right? That's what that gives you there. Same as the liquid asset ratio, which is the asset test, and the quick ratio, except that now we have less inventory. Why are we less in inventory? Because it takes longer to convert into cash. So you are saying, as a creditor, now you might want to use this ratio as a creditor. You are saying, let's go back to our financials. Should push come to shove, how are they going to pay off your money? So you can't say it's like someone owes you money and then you go and knock up at their door and then they tell you, I'm gonna pay you after I sell this thing. You see, after I sell item A, B, or C. It just doesn't sit too well. Right? That just doesn't sit too well with creditors, right? So you wanna say, in the worst case scenario, suppose you can't sell that inventory. For the reason, say there's a lockdown, right? And you can't sell that inventory. Like what's happening in Cape Town, they are locked down and shop businesses are closed. So you can't sell that inventory. So how are you going to pay off? It's gonna be the 15th, it's gonna be, maybe you've agreed to pay by the 10th of, what are we? We are in August now, by the 10th of August. So what options does this organization have? Then we are saying at least they must be able to, these are easier to convert into cash, right? 1, 2, 3, they are easier to convert into cash. So the trick again with your current assets, they are always arranged from the least liquid to the most liquid, right? That's how they are always arranged there. All right, so it takes into account that inventory may take longer to convert into cash. Then we are saying an ideal ratio must be at least at 1:1. You just don't want it to be too big, just don't want it to be. Once it's less than 1, then it's a very bad indication there. All right. We're just going to do the calculation now. For that one, you're just going to see it on the screen in a moment. Okay, we did the calculation. So other than those ratios, I think we will see inventory days, inventory turnover rate. We will cover this again as we move. Right, let's jump to the next one. So if you have any questions, again, any additions, I actually prefer additions. I love, and what I love more is subtractions, right? I love people who would disagree so we can have a conversation, right? So we could have a conversation. So if there's anything that you don't understand or anything that you disagree with, you can just let us know here, and then we iron that out so that we don't risk disagreeing with markers. Yeah? Debt to equity ratio. So debt to equity ratio, let me just see where we have it here. But These ratios, these are solvency ratios, right? These are solvency ratios, capital structure ratios here. So it basically gives you now an indication, right, of what kind of items or what kind of elements we are dealing with on the financial position. So if you can classify the ratio between, there are 4 categories here. So if you are able to classify it, it will give you an idea. For instance, if it's a capital structure ratio, which is a solvency ratio, you hardly expect to have current liabilities, right? In terms of, for the most part, you don't really expect to have quite a lot of that, right? You know that your major focus is on the permanent capital structure of an organization, right? That's what we are going to be dealing with, right? So this is it here. It's also called the leverage ratio, right? So it's your long-term interest-bearing debt. So this is a very good indication here. We are looking at the long-term interest-bearing debt. So ideally, in a normally functioning economy, you don't expect to get debt that is free. Right? You don't expect to get debt that is free. We are predominantly capitalists, right? Capitalists want to make money. So the loaners of these funds are going to charge you an interest, right? So hence, we would categorize this as an interest-bearing debt, right? An interest-bearing debt. Maybe if you're in the Middle East, Islams, I know Islams, I think they don't charge interest. I can't remember with what Muammar Gaddafi was doing, but I know Adolf Hitler was doing that. They are not charging any interest. But here in South Africa, we charge you interest, right? So hence, we are going to talk about this as long-term interest-bearing debt. So okay, why would it not be short-term interest? Right. And my network is playing around now. Sorry about that. Right. So I was still saying here we are dealing with long-term, right? So which is part of permanent financing of an organization, right? I'm just gonna reshare the screen in just a moment. So which is why, for the most part, it is gonna be long-term, right? Why, for the most part, that's gonna be long-term there, right? I just shared this here. I'm waiting for it to, right? Yeah, I don't know why now it's confusing for me to share. All right. So this again, by the way, remember you have these notes, right? You will have these notes after the class, right? I'm just waiting for it to show there on the screen, right? So you can see where all this is coming from. Right, there you go. I think you should see it now. So this is basically your long-term interest-bearing debt, including its current portion. So why are we including this current portion? It's because this current portion is still part of our long-term, in terms of the broad category, still part of our long-term interest-bearing debt, right? So in all fairness, within that financial year, it was part of our debt, right? It was part of our debt. What kind of debt? Interest-bearing debt, long-term interest-bearing debt. So be on the lookout here when you're dealing with this portion here. Sometimes there's there are instances where if you look at, say, an overdraft facility, an overdraft ideally should be assessed under liquidity ratios, and it will be assessed under liquidity ratios, unless if, like I saw in one question, where the overdraft facility was part of a long-term or a permanent capital structure. So under those circumstances, then it has to be analyzed in this category. So what are we dealing with here? Long-term interest bearing debt. Let me just copy that there. And then we take it straight to the Excel sheet. Right, we are dividing that by our equity. Right, we are dividing that by our equity. So we are quickly going to go now to the financial statement and see where we can get a hold of that information. Right, so equity. So obviously now this is where this is going to be on this portion under our equity and liabilities. Right, so equity is very easy to find. This is our total equity right there. And then our interest bearing, we obviously only have these two, right, which is the long-term loan, that 550,000, and then the debentures, which is 12,000. Right, so we only have those two. So your option, you could either take that 682,000 and deduct 120,000, or you can simply take 550,000 plus 12,000. So let's take 550 plus 12,000. Let me just put it up there. 550,000 plus 12. Oh, it's 120,000. Is it? Let me check. Sorry, I have left that screen. Okay. Oh, 550,000 plus 12,000. Yes. Plus 12,000. Okay. Then we are dividing that by what? We are dividing that by 1375. So let me just put that down there before I can share that. 1375. 1, 2, 3. All right. So this is what I was typing. Let me share that part of the screen, the Excel. Right. So if I've written it this way, you don't really have to write it that way, right? Or you can simply compare that there by all right. Thanks for that. It's 562, right? I'm just gonna write that down shortly. This network is giving me a hard time today, but we will be done in the next 15 to 20 minutes. We'll be done. I just hope the network improves by then. All right. Just gonna take. All right. So while I wait for it, I'm just gonna do the calculations there. I think it's relatively simple. 550,000 plus 12,000 divided by 1875. Okay, this is gonna be a percentage. All right. Loading here, the other device is still loading, but we will get to it. Right. Right. So while I wait for this one to load, do we have any questions? Do we have any questions? I think so far it's very easy. So far it's very easy. I think I'm just gonna skip. The other one is the gross profit percentage. We'll go to return on total assets. Or I'll start off with the inventory turnover. Yeah, 4.09. Perfect. We'll start off with the inventory turnover, and then from there we'll jump to. Right, I'll start off with the inventory turnover, and then we'll finish with the return on assets. Not one for 3 or more reasons. So let's make it as a percentage. So this one is usually expressed as a percentage. So let's just put it So in a question like the one that we have, where they are already indicating previous ratios, we can as well, okay, to 2 decimal places. So that's what I have now. We can as well stick to the formats that we have. So, right. So this is obviously times 100% there. So if you find yourself with enough time in an exam, then put those percentages. So let's skip this one. We'll tackle this one some other time. It's very easy now. All right. Besides that ratio, let's see what other ones we have. So the big thing here, guys, where most people get confused when we are dealing with solvency ratios is how to deal with stuff like deferred taxation, right? Deferred taxation, keep in mind the theory behind what we are doing here. As a financial manager, when you are assessing the long-term capital structure in this regard, you are looking at the financing of an organization. So you are not financing an organization with deferred tax. This is just an accounting item. So it shouldn't really bother you much. So that's why you are specifically saying interest-bearing debt, right? So this is the kind of debt where you are saying, if you want to raise money, right? You can't go to deferred tax. You can't raise your money with deferred tax. You can't raise funds with deferred tax. So if there's anything that's similar to that, just kick it out. Okay. Then again, the long-term, so the current, when you're dealing with the long-term loan, we specifically spoke about the current portion of this interest-bearing debt. So it becomes a current portion. Sometimes these loans that we have these days, you keep repaying the capital portion every year or every month, right? As it were. So once that repayment is within 12 months from the balance sheet date, then it's going to be classified as a current liability, because it needs to be settled within that 12-month period. But at the end of the day, it is still part of the long-term financing of an organization, right? Okay, Boitumelo is out now because of load shedding, but you will catch the recording. Okay? So watch out. So you don't just stop your analysis there, right? So on your analysis there, throw out your deferred taxation if you have it. And then again, if you have your current portion of any of these, either your long-term loan or your debentures, but in most cases, your debentures wouldn't have that, right? But suppose they do, or in whatever case, questions are not exactly the same, right? If there's any such anomaly, then watch out for that. So you make sure to include it there within your calculations, right? So that's where the trick usually is there. And then again, let's see. Okay, for instance, if you look at the debt ratio here, it measures the percentage of the total funds provided by the holders of debt, right? Including all forms of debt, right? Again, picture in mind that you are dealing with debt here, right? You're not dealing with stuff like I'm saying, that is part of your long-term liabilities or current liabilities. Doesn't really mean that it needs to be included there. You see, total assets, total debt. So this is basically the same thing. It's just the inverse of that there, right? But your guidance again is the huge topic here, the broad topic that you are dealing with capital structure, and then in dealing with the capital structure, what sort of things are classified as debt there, in terms of what can you really classify in terms of your capital structure, what can you classify as a liability there. All right, now let's jump to the one that I feel is very important. And the one that I feel is very important. Okay, now before we get there, let's quickly do inventory turnover. Right. Let's quickly do our inventory turnover. So inventory, there is an inventory turnover. Make sure that these don't confuse you. So once it deals with days, they must be times 365, right? Sometimes it's 366 days. So watch out there on the additional information, what days you are using, right? So inventory turnover. So we are dealing now with inventory. Then what are we juxtaposing it with? It's gonna be with our cost of sales. So this is gonna be cost of sales divided by, sometimes it's average inventory, sometimes it's closing inventory. Here we normally use closing inventory, but I'm just gonna recheck that right on our current. If we have current study material, then I'm just gonna recheck that, right? So let's go and fetch our cost of sales. Let's go and fetch our cost of sales, right? Why can't I see that now, right? Don't worry, I'm just gonna take us there now, right? Okay, so I was saying, don't confuse these two, inventory days and inventory turnover, but look at the similarity here. This is inventory over cost of sales for inventory days times 365. Sometimes, like I said, it's 366. And then your inventory turnover, which is going to be a rate, it's your cost of sales divided by your inventory. So it measures the number of times your inventory is sold or used within a year. So based on that, you prefer that it's higher. Yeah? You want your, it basically shows how fast your inventory is moving. Yeah? So where do we get our inventory? We have our closing inventory there, 400,000. Our cost of sales is 1050. So let's put that up there. So it's going to be 1050 divided by 400,000. Let me type that, divided by 400,000. So this is going to be given as times, whatever it is, times 1050 divided by 400. It's 2.63 times. Right? We are going to see that on the next time I'm on that Excel sheet. Right. And then your return on total assets is the one that we are going to deal with now, our return on total assets. Right. So this one in particular, let me just let's go to the Excel sheet, because I think I can pretty much pull that out of my head, because I've messed it up many times, which is why I remember it. So this is going to be your earnings before all right, interest, but after taxes. Earnings before interest, but after taxes, then we divide that by our total assets. So, right. So to round this up, we are gonna now we are gonna talk about these earnings before interest, but after taxes. We are also gonna talk about earnings before interest and tax, and then we are also gonna talk about EBITDA, earnings before interest, tax, DA. That one, we just wanna differentiate between these three. All right. So how do we identify this from the statement of financial position? So our earnings before interest, ideally, this is it here. It's our operating profit, right? It's our operating profit, our earnings before interest. But we want this now after tax, right? So which means we need to factor in the taxation there. So the assumption, let's just say tax now is 27%. We are used to the tax being 28%. So let's just assume it's 28%, and then we see how we convert that after tax. Excuse me. And then we are dividing that by total assets. So this is our total assets, 2670. So let me just put down that 2670. It's easy to pick up there. Right, divided by 2670. All right. Now let's deal with with this earnings before interest but after tax. So this is your earnings, right, before interest. So you can see that your interest is right there. So we want your earnings before you get to, before you factor in your interest, either your interest received or your interest paid. Usually it's gonna be your interest paid, your finance cost. So you don't want that included there. So where students usually get confused with this, by the way, is where our starting point is, right? Where our starting point is. So if from the formula we are saying you need your earnings before interest and tax, what are your earnings? So your earnings is your profit after tax. So if you're gonna be doing a working for this, then you are gonna be basically adding back your taxation because it was deducted. You want it before tax. So if you add back that, it gets to 380, right? And then if you deduct your interest, because in this instance it's interest received and you want it before interest, then it will still get to 300. But there is no need for that calculation if you can already see that your operating profit here is your earnings before interest and tax. So your operating profit is basically that there. But now we just need to adjust this for tax. So assuming that our tax is 28%, this is how we would go about making that adjustment. So that amount is 300,000. So it's going to be 300,000 times 1 minus 0.28, right? This is how you make that tax adjustment there. Right. So if you're already an accounting student, you know 1 minus 0.28, they normally write this as what? Times 0.72, right? But now, watch out again, if the tax rate is 27%, someone was asking me, I think one of the CTA students, where did you get 0.73 from? You see, so that's where 0.73 would come from. It would be 1 minus 0.27. Right? That would instead give you 0.73. So that's how you would make that adjustment there. So ideally, then you might want to multiply that there by 100%, right? To give you in terms of percentages, right? We are almost done. It's we have 5 minutes to go. Right. We have 5 minutes to go. So what I'm doing now, what you don't see there, I'm simply punching in the numbers there. So it's gonna be 300,123 times 0.72 divided by 2670, 123. That's basically what I'm doing there. And then putting it as a percentage. So once I'm back online on this other device, that's what you're gonna see there, the calculation for that. All right, so so we are almost done. We're finishing up, just hanging there. Okay, I think I shared the wrong one there. Right, this is what we need. All right, so there you go, ladies and gentlemen. That's your 300,000 times 0.72. So that's 0.72 effectively puts us on after tax. So in any of these calculations, once you're seeing times 0.72 times 0.73, we are trying to put this after tax, after deducting tax. So obviously, the logic behind this, you are looking at the return on your total assets. So at the end of the day, you need to pay your taxes, right? You need to pay your taxes. So whatever the case is, for the most part, we are gonna say, according to this assumption here, we are basically gonna say the return is gonna be what is left over after paying your taxes. So that's the logic behind putting this after tax. Though I must say, under normal circumstances, we use EBIT, right? We use EBIT here, which is the earnings before interest and right before interest and tax. So which is gonna be basically that 300,000. I think you wouldn't really get penalized for that. The assumption there is, remember, some of these assets are financed with debt, right? So and then debt is obviously tax deductible and what have you. So it would be nice for you to put in the raw amount. It will give you a relative picture there of what's of what's really going on. All right. And then earnings before interest and tax. Whenever you see earnings before interest and tax, this is it here. It's your operating income, right? It's your operating income. Let me show you where you get that there. Right. We only have 2 minutes left now. Right. So this is your operating income. So it's your gross profit less your operating costs. So there will be your operating costs here. So which will include your marketing and admin expenses. Right? So basically your gross profit minus your operating profit. So why is that important? Which is your gross profit basically gives you your operating revenue, right? Basically gives you your operating revenue. So it basically gives you a picture of when we talk of business operations, we are dealing with the core operations of a business, right? What a business does, right? Under normal circumstances. So that's what you want to measure there when you're talking about EBIT. Let me give this example. Say I'm a tutor, my business is tutoring, right? But I'm also tutoring with another friend, by the way, who's doing risk, right? So this guy who's doing risk, I hope none of his students are here, but he likes gambling. So he was introducing me into gambling, telling me how much money we can make out of gambling. Suppose I gamble and I make money out of gambling. That's income. That's part of income. But is it operating income? It's not operating income. I can't exactly use that as operating income to do these ratios where I'm measuring the success of a business, because it's not really within my operation. So as a business, non-core business could be saying investing in the stock market, you see. Maybe rentals, you are renting a portion of your business. So such rentals are not really part of your operating income. So when you are dealing with earnings before interest and tax, forget all these non-core stuff, right? Just let those ones go and then only deal with what is core, right? Only deal with what is core. So that's the reason why we instead do that there. All right. Just a minute now. The last one is your earnings before interest, tax, depreciation, and your amortization. So which means part of your operating costs there will include your depreciation and your amortization. So there are some formulas or some ratios that require you to add those back, right? Why would we do that? Remember, depreciation and amortization are non-cash items. So there are instances where you basically just want to rule out all these non-cash items. So if it's a non-cash item, it basically means that this is an accounting expense, can be manipulated, right? So you are saying at the end of the day, you are like, that investor will say, okay, I don't care how much profit you are making or how much your earnings are, but how much cash are you guys making, you see? Then which means you basically want to factor out the depreciation and amortization, because these accountants can crooks and then they might maybe blow up those figures to undermine your profits, or they might cut down those figures so that our earnings look like they are big. So let's just take that all out. That's what we are saying when we are dealing with earnings before interest, tax, and then again depreciation and amortization. Right. So just take note of that there within those formulas. So some of the examples that we are going to be dealing with, by the way, are going to be requiring us to make use of those formulas. Right. Let me see if there is anything that I didn't mention with regards to those there. Right. So next time, hopefully, we are just going to talk about how you will interpret these ratios before we jump to the next thing. Right. We are 2 minutes out of our time, so let me just jump out. I don't know if you guys have any quick questions before we call it a night. No quick questions, good. If you have any questions, any queries, just post them in the group. I'll respond there in the group. Otherwise, bye and enjoy the rest of the evening.